Everybody's trying to understand the systemic or the contagion risk here. We've got a couple of big notes. Citi say Evergrande, the crisis there is China's Lehman moment, given the policymakers are unlikely to uphold the bottom line, preventing systemic risk to buy time in resolving the debt. Whereas Barclays say it's a property issue and it is far from a Lehman's moment. Your call. Good morning.
Morning, Manus. We agree this is not a Lehman moment for China, but this crisis has been 30 years in the making. We've seen the Chinese populace has very little option but to go after buying a house because of the various systems, the hukou system and the other idiosyncrasies of the Chinese market, that they have to buy a property and they have to buy a property at any cost. So this crisis has been 3 decades in the making. With the new impetus that the Chinese government has of shared prosperity, I think their aim was to weed out some of the more highly leveraged players in this market. And I think they have the state capacity to manage that risk if they want to. Mm-hmm. We will see tomorrow or the after if they actually do, but they have the state capacity to manage any fallout from this crisis. And it would behoove them not to let it spill over into anything else.
Ashish, given the size and scale of some of these liabilities, the potential channels for wider contagion across asset classes is nothing short of worrying. GTV Go for our clients. Just a closer look here at the credit default swaps. This is on a 5-year basis. The cost of insuring government debt for a period of 5 years has jumped to the highest level since September of 2020. As we count down to the return to the China Open, what are you telling clients to do with their exposure to some of these China assets?
I'll be honest with you, since this whole common prosperity thread started, we have had near zero exposure to Chinese assets. We've had one small position in the Chinese bond, which is an exporter in China. But other than that, we've had near zero exposure in China. And that's what we've been telling clients, that you have to reassess China in the light that you're going to have a higher discount rate for Chinese assets from here onwards, because you've seen this before in Asia. After the financial crisis, you had corporate governance discounts in most of the North Asian markets. You see that in Russia right now, where you have a state interference discount built in Russian assets. You should see that discount in Chinese assets become much more permanent. So lower valuations, lower growth expectations going forward, all this means a market that will, for the near future, trade at a discount to US or Europe. So I think there is a bit more to go in the rationalization or the acceptance of investors that this is going to be the case. So in the near term, we don't see much value in Chinese assets. I think that value is starting to build up as we go forward, but we need to get over this Evergrande hump very, very soon.
Okay, well, we'll get some more clarity as the week rolls on. Ashish, if you're near zero in China, where are you in the US? We have this debate whether it was irrational de-risking between JP Morgan and Morgan Stanley. Kolonovich says it's all overdone by the dip. Morgan Stanley say you could be somewhere between ice and fire. They see a growing risk of a 20% drop in the S&P 500. Do you load up on the irrational dip in the US? Do you see a risk of a 20% drop?
The risk is always there. We don't see it. At the beginning of July, we wrote a note to clients saying that we see the markets around 10% overvalued at that time based on where the multiples should be. What we have seen since July is earnings have outperformed expectations and the market is flattish. So we've seen a derating and that's why multiples have come down a bit. So as it stands, we see markets 7% expensive to fair, which is kind of our limit at the moment. That's the drawdown we shouldn't be facing, because the Fed policy is still very accommodative, and earnings, while they are going to go up, may not surprise to the extent that we have seen in the past. But we're seeing still expansionary environment.
We're counting down, Ashish, just to this Fed meeting, and I want to just run this soundbite from Bill Dudley here for you to listen to. Take a quick listen.
Well, there's a risk to their credibility because, one, inflation's higher for longer. 2, inflation expectations are starting to rise. And 3, they've sort of bound themselves in terms of, when they can actually raise rates. They said they're not going to raise rates at all until they've hit 2% inflation, hit full employment, and are confident inflation is going to stay above 2% in the future. if inflation expectations get unanchored, that's going to push inflation up even before we get to maximum sustainable employment. So they could be in a tough spot.
Ashish, what does the Fed need to deliver on to safeguard its credibility?
I don't think the Fed is anywhere close to losing its credibility. We know that the Fed can act to raise rates anytime it sees an inflation threat. The question is that threat credible? Or this is the debate we've had from time to time, is this inflation transitory or not? If you see what's happening in China, for example, that is causing commodity prices to come lower, and that will cause inflation to come down a little bit. The worrying bit of inflation is obviously house prices and labor supply. And while that will progress and while that will go up over time, in the near term, you will see a positive impact on inflation from coming down of commodity prices. So we see inflation as a bigger threat next year. And by the way, I have to say that we are also going to start seeing high base effects coming up in inflation numbers too, because we've seen higher inflation numbers throughout this year. So we see inflation as a bigger threat later on next year, where you can see a momentum develop in housing prices, a momentum develop in labor costs, but not now. So I don't think the Fed needs to do anything other than stay the course, carry on its tapering, which we think they will announce somewhere in November or December, and then wait for economic growth to surprise to the upside before they act.